Right. So last week we discussed about mutual funds and hedge funds. Yeah. Any questions from last week? So we went on to discuss open-ended funds and closed-ended mutual funds. Open-ended mutual funds, there's unlimited capitalization. You deal directly with the fund itself, and the price is based on the net asset value. Yeah. So closed-ended mutual funds, they trade on an exchange. Capitalization is limited, and the price is based on demand and supply and not on net asset value. Right, so that's mutual funds. Then hedge funds are for financially sophisticated, high net worth individuals. Right, and both of them offer alternative investments to the traditional assets that we have, the traditional investment assets that we have. Then we went on to discuss pension funds, sovereign wealth funds. Right, so that's what was discussed last week. Now, today we will focus on instruments that help you raise funds. Right. Now, normally, take yourselves as an example. Take a personal circumstance, maybe putting up a house, right, or buying a vehicle. Then going to a supermarket and buying things on credit. So if you want a funding line, not only on credit, but also if you want to pay cash and buy. And so if you want some sort of a funding arrangement, right, maybe for various purposes, there are various avenues which you can use. Maybe you can use your own funds, or you can borrow, right, perhaps through various instruments like a housing loan, personal loan, credit cards, or you can use your debit card or cash or whatever. Right. Now, when it comes to making a decision on which instrument to use, what are the factors you will take into account? So if you have an expense which you need to meet, what factors will you look at? What do you think? If there's an expense which you need to meet, right? Maybe put up a house or buy a vehicle, maybe buy some groceries. Maybe spend for a wedding. What factors will you look at? What are the things you need to consider? Yeah. Hello. Nothing, is it? You just close your eyes and blindly jump into it?
Interest rates of the loan.
Come again?
Interest rates.
Very good.
Of the loan.
Yeah, you look at the interest rate. In other words, the cost. Isn't it? How much would it cost you? Right? Are you going to borrow using a tool like a housing loan, which might offer rates like 7%, or are you going for a personal loan, which will cost you maybe slightly higher, 9% perhaps? Right? What is the interest rate? Very good point. What else?
Repayment period.
Very good. The term or the repayment period. So if you are applying for a housing loan, what sort of a period are you comfortable with? Do you want to take the loan only for 5 years, or do you want to go for up to about 10 years, maybe 15, or do you want to stretch it up to about 20 years? Right. So what is the repayment period? Good point. What else? Yeah. Nothing else.
Capacity to repayment.
Sorry.
Capacity to repayment.
Very good. Capacity to repay. Okay. What do you require? What sort of a commitment does it require? You're supposed to pay about 80% of your monthly income. If that is the case, then you might not have the capacity to repay it. Right? Or is it within manageable proportions? Yeah, good point. Anything else?
The required capital amount.
Excellent. What is the amount you need to borrow? What amount do you need to raise? Yeah. Right. How much would you need? Anything else? How about collateral? Does it require any collateral? Right. So housing loans? Yes, you're right. Yamada, you are correct. Housing loans will require collateral. Personal loans usually don't require. What else? Wouldn't you look at the source? Are you going to borrow from a bank? Are you going to borrow from a friend or from a finance company? And if it's from a bank, what is the bank? Or are you going to a loan shark? And so you need to look at the source. What else? Some simple points. Because if you understand these concepts, what we're going to discuss is going to be very easy. What about terms and conditions? Terms and conditions. Basically, the finer print. What else? Yeah, the purpose. Why do you need the money? Charges, legal fees, documentation fees, admin fees. Then what about the legal and regulatory factors? Your stamp duty is also back on the charges. Legal and regulatory factors. Maybe exit clauses. Like early settlement. There may be opportunity cost. Then something I forgot to mention under collateral, loan to value. Loan to value ratio. Yeah. So anything else? Actually, it's an endless list. There are so many things you can look at. Right. Now, this is from a personal point of view. If you as an individual want to borrow, then these are some of the points that you might look at. But what about a corporate? If you are a corporate, then what happens? Then the circumstances are pretty much the same, isn't it? Even if you're a corporate or an individual and you have a funding requirement, these are some of the basic things that anyone will have to do, whether it's an individual or a corporate, isn't it? Do you all agree or disagree?
Agree, sir.
Yeah. Okay, so if that's the case, let's move on. Right. So if you are listed on the stock exchange, right? Stock exchange, you have taken a listing. Now, we did ways of the kinds of shares that can be issued, like private placement, IPO, tender, and all that. Right. That was a couple of weeks back. So using these means, a stock exchange introduction. So using these means, if you have raised funds from the stock exchange and you want to expand further, right? You want to expand further, and you feel the amount of funds you can raise from the stock exchange is limited. You can't exceed it. Right? You feel things have saturated in the stock market, and no additional funds can be raised. What you might do is you might consider listing yourself in an overseas market. Right? Now, from what we hear, there are certain companies in Sri Lanka which have listed overseas. Right? To my knowledge, HNB and John Keels have a listing. I think LOC is looking for something. So what they're doing is, when the local stock market is saturated and you cannot expect to raise a lot more funds because the market is very fragmented and investors have invested elsewhere, then what you can do is you can expand overseas and list yourself in an overseas stock market. Right now, if you take Ali, yeah, they are in the Chinese stock market as well as in New York or in Singapore, right? So they have listed in several stock markets. So the benefit is, once your stock market is saturated, you can raise funds from overseas markets, and you're giving the opportunity for overseas investors also to come and invest in the company, right? So one instrument which can be used is called a global depository receipt, or a GTR. Depository receipts are certificates that represent an ownership interest in the ordinary shares of a stock of a company, but that are marketed outside of the company's home country to increase its visibility in the world market and to access a greater amount of investment capital in other countries. Right, so this is an important point. They're marketed outside the company's home country. Right, so it's like John Keels being listed in the Luxembourg Stock Exchange. To increase visibility, now you are becoming a global company, not just a local company, and access great amount of investment capital. Right? So it increases visibility, not as a local company, but as a, you'll be seen not as only a local company, but also a global company. And you can access additional capital as well. So that those are the two main benefits. Now, if you're seen as listed in an overseas market, right? So if, for example, there is a company, let's say company X is invested in Sri Lanka, and also it has got a listing in the New York Stock Exchange, right? So it adds a lot of color to the company, a lot of value to the company. Right. One thing is, now when you list on a stock exchange, it shows that you're well governed. Right? Your governance structure is fantastic. Otherwise, you can't get a stock exchange listing. And when your listing is in a more advanced market, it means your governance framework is fantastic. There are no loopholes. Right? Any investor can come and invest with you without fear, because you're complying to the best standards in the world. Okay, so that's the primary purpose behind listing in overseas stock markets. Depository receipts are structured to resemble typical stocks on the exchange that they trade, so that foreigners can buy an interest in the company without worrying about differences in currency, accounting practices, or language barriers, or be concerned about the other risk in investing in foreign stocks directly. Right? So it's like, now if you're invested in, let's say, the New York Stock Exchange or the London Stock Exchange, right? So let's say a Sri Lankan company is listed in the London Stock Exchange. Now, for a Britisher, right, a UK citizen, to come and invest, he will be more comfortable investing in the local stock market, in his local stock market, the London Stock Exchange, than investing in the Sri Lankan market, which may be quite alien to him. He might not know the situation in the country, right? Excuse me. And the certain details of the country, even social factors like language barriers might also, cultural barriers, language barriers, exchange rates, all these can have an effect. All that most of those can be avoided if the company is listed overseas, because then the foreign investor will get share price which is denominated in his own currency, right? So if it's listed in the London Stock Exchange, the investor will see the share price in sterling pounds, not in rupees. Okay, so the John Keel's share will be listed in the London Stock Exchange, and the price will be denominated in pounds, right? So the investor will feel a lot more comfortable to invest. For one thing, he's not taking exchange rate risk, and the other thing is it's just like investing in a British company. And so he'll be more comfortable, which is why it says that the investor does not need to worry about differences in currency, accounting practices, language barriers, or be concerned about the other risk in investing in foreign stocks directly. None of these would matter. Right. Now, global deposit receipts were initially derived from what are called American depository receipts. The ADRs were the first depository receipts issued by JP Morgan and in 1927, right? So this is a bit of history, which you don't have to memorize, but it's good to know. ADRs allowed companies domiciled outside of the US to tap the United States capital markets. And so if you had raised American depository receipts, it means a company which is which is functioning as an overseas company, not residing within the US, can go and get themselves listed in the US stock market. That's called ADR. ADRs were structured to resemble other stocks on the American exchanges with comparable prices per share. Shareholder notifications in English and the use of United States currency for the sale and purchase of ADRs and for dividend payments. Right? So then it typically functioned like a US company. Okay. Everything denominated in US dollars, and they comply with US accounting standards. US governance structure also applied. The legal system was also the US. So everything was within the investor's comfort zone. He didn't have to deviate beyond that. Okay, so that's American deposit receipts. Then global deposit receipts is similar to ADR, but it is if a company is listed not in the local market and not in the USA, right? If a global, similar to ADR, but it is a deposit receipt sold outside US and outside of the home country of the issuing company. So for as long as the deposit receipt is issued outside US and outside the investor's local market, it's called, sorry, outside the company's local market, it is called a GDR, Global Depository Receipt. Most GDRs are regardless of geographic market denominated in US dollars, although some trade in euros or British sterling, right? So mostly these GDR prices are there in US dollars most of the time. There are more than 900 GDRs listed on exchanges worldwide with more than 2,100 issuers from 80 countries. That's why it's very, very popular. So let's try this example. Then you will understand better. Right, an example based on fixture share prices of John Keel's. Right, it's an ADR example. It says, just take JKT as an example. It trades on the London Stock Exchange at around 2000. So the share price of John Keel's is 2000. And in dollar terms, it's 20. The US bank purchases 10,000 shares of John Keels and issues them in the US in the ratio of 10:1. Right. So every 10 shares, or every 10 shares are combined. Right. So what they do is they issue 10,000 shares. They purchase 10,000 shares. So they have with them 10,000 shares. And what they will do is they pull 10 shares together. Right. So each 10 shares are sold as a American deposit receipt. So if you buy an ADR, then you have bought effectively 10 shares of JKH. This means each ADR purchase is worth 10 JKH shares. Right. Each ADR is worth 10 JKH shares. One share is $10, then 10 shares equal to 1 ADR equals 10 $10, which is $100. Each ADR is worth $100. Sorry, one share is equal to not 10 but $20. So 10 shares is worth 10 into 20. $400. Once ADRs are priced and sold, its subsequent price is determined by demand and supply factors like any ordinary shares. Okay, so what you can do is initially when this is launched in the US, if you buy one ADR, if an investor purchases one ADR, effectively he has bought 10 shares of John Keels or had invested in $200. Right? So this is the opening price. This can be the opening price, but then subsequent prices are based on demand and supply. When the demand goes up, the price goes up, and when demand drops, the price will also drop. Yeah. Any questions up to now? Okay, so subsequent prices are based on demand and supply. Okay, any questions? Then share issue. First one is ADR or GDR is issued when the domestic capital markets are saturated. Right? When local capital markets are saturated, then you can expand overseas into overseas capital markets. Another type of share you can use is preference shares, ordinary shares as well as preference shares. Now, preference shares we have already discussed. It's a company stock with dividends that are paid to the shareholders before common stock dividends are paid out. Now, preference shareholders obviously will get preference over ordinary shareholders in terms of Dividend payments as well as liquidation. So if the company is paying dividends, then you need to pay the preference shareholders first, and then you can pay ordinary shareholders. Likewise, if the company is being liquidated, then you have to pay preference shareholders before you pay ordinary shareholders. Preference shares typically pay fixed dividends, whereas common stocks do not. And unlike common shareholders, preference shareholders usually do not have voting rights. Now, that's the disadvantage of buying preference shares. You don't have voting rights. So effectively, it is like voting and non-voting shares. Advantages of preference shares. There will not be a loss of control within the company because the preference shareholders do not have the voting rights. Right? So that's one of the main advantages to existing shareholders. Their ownership will not reduce. Right? Because absolute ownership of a company is with ordinary shareholders. They are the ones who can vote at AGMs, appoint directors. They can even call for AGMs or EGMs. Right? So that's the right of an ordinary shareholders. They control companies, whereas preference shareholders, that is not the case. They do not own companies. They will have to reap the benefits of investments made by ordinary shareholders. That's what happens with preference shareholders. Right, so preference shares can be raised for a specific time period, at the end of which it can be repaid. Now, if you want, you can have redeemable preference shares, which have a specific maturity date. When it matures, you can repay the investors. Thereafter, company need not pay preference dividends. So once preference shareholders have been fully settled, you don't have to pay preference share dividends of preference shares. The risk of financing will be less when compared to updating a loan, because the preference dividend will be paid only if distributable profits are available. Right, so that's the main difference between debentures and shares. Right, so this one we have already discussed when it comes to debentures or any liability for that matter. They receive priority in terms of liquidation, right? So debentures in any advance will get priority. So before ordinary shareholders are paid, you have to pay the preference shareholders as well as other liabilities. Yeah, so voting rights, remember, are with ordinary shareholders and not with preference shareholders. It can be raised for a specific time period, at the end of which it can be repaid. Thereafter, company needs to pay preference dividends. Right? So it can be choose both for these are redeemable preference shares which can be redeemed after a certain period of time. You need not carry them for eternity. So if there's an attractive offer, you can always redeem redeemable preference shares. But irredeemable preference shares, that is not the case. You can't redeem as and when you want. The risk of financing will be less when compared to updating a loan, because the preference dividends will be paid only if distributable profits are available. Right. So that is the main advantage, as we discussed last week. Remember, you are transferring the risk of performance from the fixed income investor to equity investors when you invest in equity. Also, dividend payments is not compulsory. You can pay dividends to have money. you don't have money, you can hold it. Last point is, while taking a term loan, security needs to be given to financial institutions in the form of primary security and collateral security. There are no such requirements, and therefore the company gets the required money, and assets also remain free for any kind of charges on them. And so this is also about preference shares. Okay, so you have unencumbered assets which you can use later on if you need to leverage or borrow against them. Also, your gearing ratio will not get affected in a negative way. Okay, so any questions up to now? No questions? Disadvantages of preference shares. An interest on debt is tax deductible expense, whereas the dividend of preference shares is paid out of divisible profits of a company. Right? So dividends, you get taxed. Sorry, interest you get taxed, whereas dividends does not get taxed. So you will have to pay it as an individual investor. Skipping dividends, disregard market image. So it's not good for you if you continuously do not pay dividends to your shareholders. Commercial papers. Commercial paper. I think commercial paper we have discussed earlier. So any idea what it is? Commercial paper is where an organization wants to borrow from short term. And short term borrowing requirements can be met using commercial paper. So it can be short term notes issued by large, strong companies. Commercial papers trade the market at low rates, just about the T-bill rates. Okay, so there is not much of a disparity between treasury bill rates and commercial paper rates. They almost move in tandem, but commercial paper rate should technically be higher than bank repo rates, right? Otherwise, there can be arbitrage. My question is, how can there be arbitrage? Because what happens is if commercial papers are trading below treasury bill rates, nobody is going to buy treasury bills, right? Everybody will want to invest in commercial paper. Okay, so there will always be a mispricing between the treasury bill and commercial paper. And sometimes you might be able to make use of it. Then debentures. Right. The question is, what are debentures? What you should know is the difference between commercial papers and debentures. What are the differences between commercial papers and debentures?
Debentures are long term.
Very good. Very good. Debentures are long term. Excellent. Which means commercial papers are short term. Yeah. Second thought, let's make this similarities and differences. So debentures are long term.
Debentures are issued to raise funds, whereas commercial papers are bought by surplus cash.
Short term debentures, long term. Sorry, I couldn't get the second point. What is that? Debentures are issued through?
Debentures are issued to raise funds. Commercial papers are purchased by excess cash.
Okay, right. Well, it's like this actually. Now, the same company can raise both debentures as well as commercial papers. Right, so John Keys can issue commercial papers. They can also issue debentures. That is from the borrowing side. What you actually said is from the borrowing side is one. Where if you have borrowing requirement, you can issue debentures, and if you want to lend or invest, then you can invest in commercial papers. That's what you said, right?
Yeah.
Yeah. Whereas actually, if you want to borrow, looking at it from the point of view of a borrower, you can borrow using either commercial papers or debentures based on your borrowing needs, whether it's short term or long term. Other difference might be commercial papers always issued at a discount. Whereas debentures can be at a discount or premium. Similarities, both are issued by corporates and not by governments. So always issued at discount means if the price is, the face value is actually 100, it might be issued at a price of 90. That's at a discount. Then if it's issued at a price of 110, it is a premium. But if it's issued at 100 itself, then it is at par. Yes, Marisha, very interesting point. Both the unsecured forms of debt. Well, partly correct, because commercial papers and debentures can be issued as clean facilities. You can have unsecured commercial paper as well as debentures. But if the lender insists on some security, then you can issue them as secured, a secured facility. Maybe you can secure it against your future cash flows, right? Or against a property mortgage, something like that. So it's not necessarily issued as without the security, right? It may or may not be issued without security. Okay, so it's not always unsecured. Understood? Not always, but your answer is correct. Most of the time unsecured. Another difference is commercial papers, zero coupon. Debentures, they have a coupon. Coupon is every 3 months, maybe 6 months, there is a periodic payment. It could even be annual. Commercial papers will not have coupons. Debentures will have. Yeah, very fun.
Easily convert for the cash.
Come again?
Easily convertible for the cash.
Okay, convertible into cash. Good, good, very valid. So my what I can put example is, now those of you, well, actually before you get married, right, you are liquid, isn't it? then after you get married, you become more liquid. Okay, so that's liquidity. How soon you can convert, and how soon you are transferable. Liquidity, isn't it? So as you rightly said, how easily you can convert yourself into not just cash, into another asset. It need not be cash. It can even be another asset. Now, for example, if this pen, right, let's just assume that everything I have is only the pen, right? All I have is a pen. Then if I'm hungry and I want to buy a loaf of bread, I should be able to sell this and buy a loaf of bread. Okay, so how long will it take for me to sell this pen? So because if I sell this pen, I will get cash, and with that cash, I can buy bread. Okay. Now, for me to sell this pen, it might take a significant amount of time. But if I have ₹100 note with me, then I can straight away give it and buy a loaf of bread. Okay. So the point is, both of these are assets. Now this pen is an asset. I can if I want, if I really wish, if I have the determination to do it, I can convert this into cash and buy bread. Then when I convert to cash, that cash is also liquid. When I buy bread, bread is also liquid. So eventually what has happened is this pen, which was an asset to me, has got converted into a loaf of bread, which is another asset. So how quickly can I convert this asset, this pen, into a loaf of bread? Right? That is liquidity. If it takes a long time, that means I am illiquid. But if I can do it with the greatest of ease, then I am very liquid. Okay, so if everyone is willing to accept pens and exchange it for food, then this pen becomes very liquid. Okay. So debentures as well as commercial papers may or may not be liquid. It's very difficult to say that debentures are more liquid or commercial papers are more liquid. What else can you say? As a medium of exchange, right? What you mean is your asset, if you want to convert to someone else, if it's a commercial paper, it is easier than it being a debenture. So that's good thinking, but that is actually not the case. Huh? It's right. Debentures are bonds that are not secured by specific property collateral. Instead, they are backed by the full faith and credit of the issuer, and bondholders have a general claim on assets that are not pledged on other debt. Right. And convertible debentures. So this one we discussed last week also. Convertible debenture is a debenture which at some point can get converted into shares. Right. That's called a convertible debenture. A debenture, when it matures, can get if it can get converted into shares, it's called a convertible debenture. Convertible bonds are originally issued and classified as bonds, but have the option to convert into fixed number of the issuer's common shares and can be thought of as bonds with call options attached. So debenture plus call option gives convertible debenture. Right. Call options we will cover in detail later on. So what we should know for now is that a convertible debenture is a combination of a debenture and a call option, right? Now what they will do is initially they will issue a debenture. Let's say it's a 5-year debenture. So it is issued by company A. Now what they will say is this will be 10% coupon, 10% annual coupon debenture issued on the 23rd July 2021. So this debenture will mature 5 years from today on 23rd July 2026. Okay. A 5-year debenture. Okay, so what A will say is that when this bond matures, so this is issued today at a price of 100, and every year they pay a coupon interest of 10. Right? Now A will say when the bond matures, two debentures will be converted into one share. When the bond matures, two debentures will be converted into one share. That will be the convertibility feature. The convertibility option is two debentures can get converted into one share. Now, what do you think should happen for this debenture to become a share? The market price of this debenture should be what? In 5 years, for this debenture to get converted into a share. Yeah. Right, that's a good try. Okay, let me repeat the question. There is going to be a debenture issue today, right, by company A. It will be a 5-year debenture maturing in 2026, issued at a price of 100, each debenture at a price of 100. And what A will say is, at maturity, 2 debentures can get converted into 1 share, right, if the investor is willing. So what do you think should happen to the share price for this debenture? If you are the investor, when will you convert this debenture into a share? Under what circumstances will you convert this debenture into the share? What should be the price for you to decide? Right. I'll give you another clue. Right. What if the share price is 150? What will you do? Then if the share price is 250, what will you do? If the share price is 150, will you convert or not convert? And if the share price is 250, will you convert or not convert? $150, what will you do? 150 you will convert, right? Let's say you converted. Huh? That means you have converted 2 of your debentures into 1 share. Okay, 2 of your debentures getting converted to 1 share. So 2 debentures, each priced at 100 means 2 debentures is worth 200 rupees. Isn't it? 2 debentures, if you let them mature, you will get 200 rupees. Right? So 2 debentures are worth 200 rupees. Then if you convert it into a share, you will get a share which is worth 150 bucks. What is preferred? If I were you, I will convert to debentures. Right? I will redeem the debenture, because if I redeem, I get 200 bucks. And if I want, I can use the 200 bucks, pay 150 rupees and buy a share and have 50 rupee balance. That is one option. The other option is when the price is 250. Yeah. When the price is 250, if I convert the debenture, if I redeem the debenture, I'll get 200. But if I convert it into a share, I'll get a share which is worth 250. Right? So I will convert it into a share if the price is 250. And what I'll do is I might sell it in the market. Right? I might sell in the share in the market. I will get 250 rupees, which is 50 rupees more than what I should have got. So if the price goes up, I will convert. Price comes down, I will not convert. That is how convertible debentures work. Clear? Any questions on that? That's an important concept. I hope you understood. Convertible bonds are originally issued and classified as bonds, but have the option to convert into a fixed number of issuers' common shares and can be thought of as bonds with call options attached. And so they are bonds with call options attached. The conversion ratio, which is usually based on, this is the conversion ratio, 2:1. In this case, 2:1. Is determined at the time of issuance. convertible debentures are hybrid securities which offer advantages of both bonds and equities. Right? So hybrid securities means you can continue as a bond, then you get typical features of a bond. But if you convert it to equity, then it becomes an equity, it becomes a share. So when it becomes a share, you have ownership into the share. You can exercise your voting rights and all that is also there. Like ordinary bonds, they offer regular interest income through coupon payments and a degree of downside protection not found in equity. Right? Downside protection is because the minimum you will get is 200 rupees when it matures. Similar to equities, they also offer generally unlimited upside potential for capital appreciation in rising equity markets. Then advantages to the issuer is, the main advantage is because of this conversion feature, he can issue it at a discount, right? Meaning, issuing at a discount meaning he's actually issuing at a premium, right? Because instead of issuing at 100 rupees, he might be issuing at 110. Why? Because of this conversion feature. He's not giving it free to the investor, for that he's charging a certain amount. That amount that he charges gets reflected as an additional inflow. Yeah, because if you are investing in this bond, if you are investing in the bond, you have to pay $100 to the borrower. You have to pay $100, right? If you are investing in the bonds, in this debenture, you have to pay $100 to the borrower. But along with the debenture, you also buy the convertibility option or the call option. So let's say the call option costs you $10. Then your total cost will be 110. Okay, so instead of getting 100, now the borrower will get 110, but his cost is still the same, 10%. So what happens is cost is 110 over 10, which is 9%. Okay, he should have paid 10% cost, but now he'll end up paying only 9%. So he's saving something. It's an attractive financing vehicle for an issuer, as they provide a cheaper way to raise permanent capital. So it's cheaper than a normal debenture. The benefits to selling convertible bonds is a reduced cash interest payment. Right? So interest cost is less. Issuer is effectively selling a call option on their common stock to allow for cheaper cost of funding. It's a common stock basically. A call option on the common stock. Convertibles are also offer tax advantages to the issuer, as fixed interest payments are tax deductible. So there are tax benefits also, because interest expenses can be deducted for taxes. So there is a tax sale. Yes, any questions on that? No questions. So the cost to the issuer. Now, if it gets converted into shares, there can be a dilution of ownership. Why? Because let's say originally company A had shares of 100, right? Had shares of 100. It had 100 shares. Okay. Out of this 100, say one person owns 100%. I own 100% of this company. Right? Now, when these debentures get converted into shares, let's assume that they issued additional 50 shares. Additional 50 shares was issued. So my ownership will then drop to 100 out of 150. 67%. 100%, it now drops to 67%. So my stake will reduce. There will be a dilution of ownership. That can happen. Yeah, so dilution of ownership is a issue that has to be faced. That may have to be faced. Cost of having a lower interest expense is a potential dilution of shareholders' equity caused by exercising the conversion feature. Yeah. Any questions? No questions? It's a very interesting concept. I think you all understood. Right, convertible debentures once again. Okay. It's a 5-year debenture. Right? Each debenture is issued at a price of 100. Maturing 2026. So every year you get coupon payments. Right? Then when the debenture matures, you give an option for the investor to convert 2 debentures into 1 share. 2 debentures into 1 share. This is the conversion ratio. 2:1. It's 2 debentures worth $200 will be converted into 1 share. Now you will convert only if the share price is more than 200. You will only convert if the share price is more than 200. If it's less than 200, there is no point converting. Okay, so if the price of the share is more than 200, then the convertibility feature will get exercised. So for the borrower's point of view, the borrower will receive the initial $100 because the investor will pay $100, and also for the call option, the investor will pay the borrower. Right? So he will receive additional maybe 10 rupees. So the total received by the borrower will be 110 instead of 100. But his cost is still the same. Now, every year he pays 10. Now his interest cost will be 10 by 110, right? 9%. Now, if not for the conversion feature, he would have paid 10%. But because of the conversion feature, he now ends up paying only 9%. So his overall cost has gone down. Cost is less. It reduces cost. Okay, so that is the benefit to the borrower. But the downside or the disadvantage to the borrower is, let's say I own this company. It's 100% owned by myself. That's, let's say, 100 shares, and I own the entire 100%. Right? 100 shares. Now, because of this conversion feature, let's say another 50 new shares gets added. That's 100 debentures If they get converted to shares, another 50 shares will get added. But my ownership might still remain the same. The balance 50 might come from a bank or another investor. Okay, so I still have 100 shares out of 150 now, meaning my ownership will reduce to 67%. From 100%, it is down to 67%. So there can be dilution of ownership. I hope that was clear. Yeah, any more questions? Then leverage buyout. Right, we did leverage last week. Can you remember? Leverage is good if your return is more than the cost. For as long as the return is more than the cost, leverage works for you. But the moment your return drops below the cost of borrowing, then you will start losing capital also. Okay, so leverage buyout means obviously borrowing and buyout. If you leverage and buy another company, it's called leverage buyout. The acquisition of another company using a significant amount of borrowed money, bonds or loans, to meet the cost of acquisition. Right, so you are using a lot of borrowing to purchase another company. And the recent past, there has been lots of leverage buyouts in Sri Lanka. Okay, okay, so when you do a Google search, you can easily come across those names. Often the assets of the company being acquired are used as collateral for the loans in addition to assets of the acquiring company. So there can be collateral involved in leverage buyout. The purpose of leverage buyout is to allow companies to make large acquisitions without having to commit a lot of capital. Okay, so if you want to make a large acquisition and you have borrowing lines, then you can make use of them. That's called a leverage buyout. Securitization. Securitization is a process of pooling together a group of receivables from financial assets and issuing of fixed income instruments to investors based on the strength of future stream of cash flows. Right. So what you do is now your assets. If you are a bank, you have various kinds of assets now, because you might have housing loans, personal loans, credit cards, gold loans, right? All sorts of loans, which are your assets. And each of these loans will give you certain amounts of cash. Right now, you take the concept of a housing loan. What happens is you pledge your property as a security and borrow against it. Right? So the property is an asset which can be pledged and borrowed. So on a similar basis, the assets that a bank owns, in other words, the loans can be pledged as assets, and those cash flows can be used to make certain borrowings, right? They are called securitization. Yeah. So this is where it begins. The originator is the origin bank. They will have given loans out to these borrowers, right? Say these are all housing loans, and the bank will be paid periodic cash flows by the borrowers, right? Might be housing loan installments. Now, if there is a securitization, if this bank wants to do a securitization, then it will pick some of the housing loans, maybe portfolios, and transfer it to what is called a special purpose vehicle, right? SPV, special purpose vehicle. A special purpose vehicle is a separate legal entity from the original bank. Right? It can be created for this purpose only. So even if the bank does not goes bankrupt, this special purpose vehicle will continue to operate. Right. So then what happens is, once the asset or the housing loan portfolio is transferred to the special purpose vehicle, the cash flows that are now generated by these assets are then channeled through the special purpose vehicle. Right. So the special purpose vehicle will then issue securities using the cash flow, strength of the cash flows from these borrowers, and investors will purchase from them. Right. So part of the cash flows that are coming from original borrowers will be used to settle interest and principal to the investors in securitization and securitized assets. Yeah. And at the origin of the securitization, whatever collected by the special purpose vehicle will be transferred to originate. And if there is any residual amount, it will be transferred at the end of the term or the loan to the original borrower. That is securitization. Any questions up to now? So the eligible cash flows for securitizations, what are eligible for securitization? You can have contractual cash flows like your housing loans, your leases, personal loans. So every month you get a fixed installment. Rent receivables. Those are called contractual cash flows. Every month you know how much you're getting. And non-contractual cash flows, things that are not uniform every month. Sometimes, in some cases, you might not have any utilization at all. Right? T receivables from brokers, credit card receivables. Some people might pay the minimum and not the full amount. If that is the case, then it's difficult for you to decide how much you to expect. School fees also might be a little erratic, right? Because the timing of cash flows might not be perfect. Utility bill payments and rates, payment of electricity bills, rates, and all that, toll collections, right? Highway tolls and all that. Okay, so what are the advantages and disadvantages of securitization? What do you think? Pluses and minuses of securitization. How is securitization going to be used?
the risk is low.
Meaning credit risk, isn't it?
Yeah.
Right. Well, actually, although the borrower is selling it to the special purpose vehicle, the legal ownership is still with the original lender. Right? If there is default, then the original lender is the one who will have to take the hit. He cannot transfer it to the investor in securitized assets. He will have to replace that asset with another asset. So actually, the risk remains the same. But good point. Good that you brought it up. What else? Yeah. One thing is, it generates additional liquidity. Liquidity which wasn't there. Now, there's a certain amount that the bank can lend. Beyond that, it's very difficult, right? Additional deposits will have to be mobilized. But if it's difficult to mobilize deposits, one thing a bank can do is do a securitization, or a finance company can do securitization. So it generates additional liquidity for lending. It generates additional liquidity for lending. Yeah, you all have mentioned some valid points. Might reduce costs. Point right. Might be complex to arrange at short notice, because you need to set up a special purpose vehicle. Then there can be costly costs involved to set up the SPV, like legal costs and all that. You might have to recruit staff. There are additional costs. Yeah. Then maybe the investor does not have ability to analyze quality of cash flows. Yeah, Marisha, this does not involve shareholders. So this is also like additional leverage, borrowing, not sharing capital infusion. Okay, understood. Okay. So these are the pluses and minuses of securitization. The parties to a securitization process, it involves, remember, setting up a special purpose vehicle. So there will obviously be a lot of lawyers also coming into account. You need a structuring and a placement agent, right? Someone to advise you, guide you through it. These are all costs, adds to the cost. Then you need a trustee or an escrow agent. He's the one who will make sure that all the cash flows are happening very smoothly. And the special purpose vehicle is acting on the in the best interest of the investors. That will be ensured by the trustee. You will also need lawyers. Yeah. Because lawyers also play a critical role. They should ensure that the special purpose vehicle is delivering what it promised. Auditors, annual audits, very important. Trust certificates, trust certificates. Somewhat similar to securitization, right? Here you will have a trust, right? What happens is you need to initially have an arrangement with a trustee, right? So the trustee will be appointed to manage the trust, and then a mortgage over the receipts and underlying assets of the agreement, right? Which you need to negotiate with an issuing company. Then you need to find investors who will invest in the trust. Investors pay cash and buy trust shares, trust certificates. Then the trust pays cash to the originator as consideration to the transferring the underlying assets. Right? So the trust is actually like a post box. It will collect cash from investors and give it to the issuing company. Right? So the issuing company is now the borrower. The actual borrower is the issuing company. So they have set up a trust managed by a trustee to raise funds on their behalf. So they will tap investors. The trust will tap investors to find funds. Right? The investors will give cash to the trust, and then in turn the trust will give cash to the originator or the original borrower. Now the original borrower will be pledging some of its assets to secure some of the payments. Right? That will be done through maybe mortgages. right? And these periodic cash flows or payments will have to be monitored by the trust and the trustee. The trust issues a trust certificate eventually, right? So the investor then can have a legal claim over the cash flows. So servicing of trust certificates, right? Now, if the original borrower or the bank has issued monthly, has given out loans as leases, right? Then it will receive monthly lease rentals. Okay, so out of the monthly lease rentals received, part of it will go to settle the borrowing. And the trust will make sure that the investor will receive the cash flows from the monthly rentals paid by the borrower. Okay, so that's where the trust ensures that the original borrower is adhering to its promise. If there is any cash that is available, it will get routed back to the borrower. Okay, trust certificates. Legal documents, you need board resolutions, trust deeds. Right? Again, a complicated process, mortgage bonds, irrevocable powers of attorney, and trust certificates. Then how do you enhance your credit? Now, if your credit quality is low, how can you try and increase it a bit? This credit quality is very important. You would have heard of rating agencies, which give credit ratings to companies as well as to countries. Right, recently, Moody's put Sri Lanka on a negative ratings watch. So rating agencies will give credit ratings. What are the rating agencies you have heard of? Yeah. Rating agencies?
Fitch.
Sorry, Fitch. What else? S&P, Moody's. Then Sri Lanka, we also have ICRA. Right? These are the rating agencies. They will give credit ratings. And credit ratings can either be investment grade or non-investment grade. This is also called junk. What is the highest possible investment grade? Highest possible investment grade? Yeah. It's called AAA. It's the highest possible investment grade. Then you have AA plus, then AA minus, A plus, A minus. Then we have BBB plus, BBB, and BBB minus. So this is the highest. BBB minus is lowest. Right. So highest possible non-investment grade is BB plus. BB plus is non-investment. Then we have BB minus, B plus, B minus, CCC plus, CCC. Then next CCC minus, and then we get all the default rate. Right. So where is Sri Lanka? Sri Lanka is here, CCC by Fitch. And the advantage of going up this rating is it means your risk profile is improving, right? So the credit risk charge that you have to pay will minimize. Clear? So those are rating agencies. Now, if your rating is low, ways of credit enhancements are selection of a quality portfolio. Right? So now, if you are using your leases, maybe you can use your housing loan portfolio because the default rates are low. You have increased the quality of the portfolio. Over collateralization, you have given additional collateral. So they might have asked for 100 million collateral. You have given 120. Month-to-month cash flow matching. You can do cash flow matching process so that your cash flows are smooth. Mortgage of selected portfolio. Right? Irrevocable power of attorneys. Replacement of contracts. Capturing risk rentals at first source to service certificates. Unencumbered portfolios. And recourse to issuing companies. Now, these are some of the difficult things that you all do as lenders also. There's actually nothing new to learn. Right? So that's on enhancing credit quality. Minimizing the risk to investors, right? If the issuing company and the borrower, the lessee is paying, there's absolutely no risk. Right? If issuing company is paying and lessee is not paying, then you have to remove the lessee and replace it with another lessee. Issuing company is not paying, lessee is paying, then you have to use your power of attorney to pay. Issuing company and lessee is not paying, you have to use the mortgage. Okay. Documents, information memorandum, you have to have details of the board of directors, senior management. And these are typical things that are asked when you do issue a trust certificate, right? Key shareholders, the financial stability of the company, repayment capacities, industry analysis, internal systems, feasibility, asset quality, non-performing loans, and provisioning report. Right, you have to go through rating agency reports as well. Okay, right. So we have come to the end of today's session. Any questions from today? Okay, so if no questions, we can wind up, and we will meet again on Sunday at the same time. All right, so stay safe. Enjoy the weekend. I'll meet you on Sunday.